Hello, and thank you for checking out today's market update video. Today is Tuesday, February 12th. It's about 11:40 a.m., so about a little less than halfway through the trading day. For those watching this video, you may have gotten my post from yesterday that I was out of town for about 7 days. It was a pretty eventful week away, I suppose. As we can see from this chart, this is an S&P 500 daily chart. Over the past, really looks like about maybe 2 weeks, 3 weeks, the market went from being at all-time highs, having a very quick, roughly 6% decline, and then it's had a nice rally these last few days. I always kind of caution folks when we're in these great bull markets that we have to be sometimes a little bit patient if there is a correction. It's amazing to me how market starts off the year sort of dour and has these 5 or 6% declines, and all of a sudden there's news reports and there's articles online and magazines talking about this great big correction that's coming. Now, it's not to say that a larger scale correction or a reversal in the market's trend couldn't happen. It's certainly very possible, but we have to remember as we look at a chart like this, we've been in an uptrend now for a few years. This current uptrend is which really started last summer, kind of the early to mid-June, and it's identified by these two red horizontal bars. The top, obviously, sort of the top end of the trading range, and the bottom solid red line is the bottom of the range, and I put this sort of dashed line as close as I could right through the middle of it. And the reason I did this is that as we've been moving through this range, every time we've gotten to the top, it hangs around there for a while. It'll fall down. It tries to find some ground here in the middle area. If it doesn't stop there, it drops to this bottom end of the range. On its way up, it tends to stall a little bit in the middle before then hitting the top end of the range and so forth. And we can see it's been repeating that process now for about 10 months. Prior to this rally, there was an even stronger rally that happened before. These are the two blue lines, and it was going on so long that it actually falls off the chart here. That rally was a sharper rise. We can see that just by sort of the angle of those two blue lines. And then the range was tighter, meaning that when it would have a correction, it was a lesser correction. So, from the top to the bottom might have only been 3% or so. And as investors, we sort of get spoiled when we have market rallies or uptrends like that because, when we don't see anything bigger than a 2 or 3% decline for a long time, we start to get used to it. And when we finally see a 5 or 6% decline, it seems like, again, the end is near and everything's going to get dour and dark and nasty. But this current rally, this little, again, 5.8 to 6% decline that we had, it's not the first time it's happened. In fact, we've seen that it happened right at the beginning. It happened about a month later. It happened about a month later. We then went into a really nice sort of finish the last 3 months of 2013. And this is actually the fourth time we've seen this type of a decline. And the market's rallied right back up. It's in this middle range again. We can see that today the market's down just a hair. So it's sort of, again, stalling in the middle. Now, as far as what this means looking forward, if we find the market rallies, but its high is not as high as the previous high, so just a simple lesson in technical analysis or market trends, if we see this rally that's just happened the last few days, if it stalls, for example, here and starts to go down, that would actually be a bit worrisome to me, because what it shows is that the previous high is higher than the current high. And what that usually means is a reversal of the trend, or at least a change of it. It doesn't always mean a reversal. The easiest lesson we can see in that is back when we broke out of the blue trend that happened from 2012 through mid-2013. The market was trading in its range, went down to the bottom of the range, fell out of the actual trend, and then went down further. So when it went down and then started to rally, it stalled and fell before making a new high. That's usually the end of a trend, and it actually was the end of the trend in that case. So as far as where we are now, we're at this point where if the market stalls here and it doesn't end up setting a new high, there's a very good chance that the current trend we're in will be broken. Doesn't mean that it starts a downtrend, as evidenced by how we went from, again, the blue range on the left of this chart to the red range on the right of this chart. It just means that this particular, very simple, easy to follow trend we've been in for about 10 months would likely come to an end. It may end up being the same as what happened before. It falls below and then starts a new upward trend. Or it could fall below and actually start a longer term downtrend. The really key takeaway is that there's no reason to panic right now. Having a few percent corrections after markets have rallied 100% or more over a 5-year period is actually quite common. It's quite normal, and it's nothing to be afraid of. If we do end up falling into an actual downtrend, usually our models will pick that up somewhere between a 5 and 10% decline, and then they start to get into a rather defensive mode. If that happens, of course, I'll let everybody know. There's a few different charts that I show on here that help us identify those longer term market trends. But as we sit here today, we're only about 2-3% off market, U.S. equity market all-time highs. So we don't have, again, any reason to panic. The good news, too, has been the fixed income markets have been relatively strong this year. So if we look at this same date range and we simply change this to the bond market, I don't have any lines drawn on here, but we can see how the bond market had a rather big drop last May. This is when Ben Bernanke announced the start of tapering, which meant that the Federal Reserve was going to slow down their bond buying. When there's less buyers of something, the prices always fall. So we saw bond prices really go down. But since they hit their bottom in early September, bond prices have slowly and steadily increased. In fact, if we look at just this year, year to date, which is right about, you can see where my cursor is, the start to 2014, bond prices have done quite well. So investors that have had balanced portfolios throughout this entire time, some stocks and some bonds, they haven't had perfect results, but when there's been some trouble in the stock market, at least this year, the bond market has been very helpful. It's been that buffer that we usually look to when thinking about bonds in an overall asset allocation. As we look forward to the rest of this year, I don't think we can expect bonds to be making 1% a month the rest of this year. Yields are simply too low. But it is encouraging to know that the Fed has started tapering. It's already sort of priced into the market. And what's happening is the more natural relationship. When stocks are really performing strongly, the bond market is, we'll say sort of muted or not doing quite as well. When the stock market suffers, all of a sudden money is flowing into bonds and bond prices are holding up. So we're getting that sort of yin and yang effect that bonds and stocks normally have. And that's reassuring. So that's it for today's market update. I'll certainly be covering more as the rest of this month unfolds. I'll be very curious if we again go back to our S&P 500 chart. Very curious to see if we can stay in this range. If the market does stall, of course, as soon as I see any signs of trouble, I'll be sure to create a video update and publish it to the blog so that clients and readers and followers can get our take on where we think the market is heading. That's it again. Thanks so much, and also thanks for your patience, everybody, while I was away on vacation. I don't take a lot of vacation time. So it felt really nice to have a week off and just sort of recharge a bit. Very excited for 2014 and look forward to publishing more videos and more content that helps people all over the U.S. Have a great rest of the week. We'll be in touch soon.